Hey guys, Dave Keller here with Market Misbehavior. Sentiment indicators are a way of trying to get inside the head of other investors, understand whether they're bullish or bearish or neutral on a particular asset class, particular area of the market. Today we're going to talk about one key market sentiment indicator now at a bearish extreme. So on this channel and in my work for Market Misbehavior and for StockCharts TV, we talk a lot about a three-pronged approach to market analysis, macro analysis: price, then breadth, then sentiment. It always starts with price. I was taught by John Murphy when I read the first book I read on technical analysis, which is the first book many of us read, Technical Analysis of the Financial Markets. John Murphy talks about how price is a reflection of all known information, really a reflection of investor psychology, an aggregate of what all the different investors are thinking because it's expressed in their positioning, and that in turn affects the price. So price tells you what investors are thinking, really just based on the trends and the movements in the underlying price. Breadth is an interesting component, particularly when we're talking about broad analysis, because a market index is taking a bunch of stocks and aggregating their performance into one data series, right? One data set of a stock market index. Breadth data actually tells us a little more granularity on the performance of the individual stocks that make up those indexes. And because often they can become disconnected. Price does one thing, breadth does something different. We've done other videos on this channel that I think cover breadth pretty well. The third piece, which is still an important one, is sentiment, which is not what price tells us. Sentiment actually directly asks investors, are you bullish or bearish or neutral on this particular asset class over this outlook period? Now, sentiment can have a couple different forms. We're going to talk about survey data today. I also group things like volatility data, using the VIX as an interesting measure of sentiment. Positioning data like put-call ratios, what else would we put in there? The RIDEX flows, right? An example of how people are positioned. But today we're going to talk about the AAII Survey. It stands for the American Association of Individual Investors. It's a weekly survey of a group of individual investors, and they're asked, are you bullish, bearish, or neutral on stocks for the next 6 months? And they give their weekly tally. What's most meaningful, I think, about this data series, we have such a rich, deep history, so you can see how the sentiment has been around major market turning points. And particularly when sentiment gets to extremes, we have some good historical references to pay attention to. So we're going to look at the chart here in a second. You'll see why it's at a bearish extreme this week. Before we get there, though, if you like this sort of thinking about investor decision-making, psychology, behavior, and technical analysis, I hope you'll subscribe to my channel. It'd be great to have you along this ride. Also, give the video a like if you appreciate it. We'd very much appreciate that. Back, put a comment below. Are you bullish or bearish on the S&P here, and why? Let me know in the comments. Let's get to the chart. Okay, so here we're looking at the AAII survey, and this is something I review every week on my show on StockCharts TV. And with my premium members, we focus on some of these sentiment measures, really when they have market moving possibilities. And so we certainly are talking about this particular chart this week. The AAII survey, again, one of the great values of it is that it has such a rich history. So we can pay attention to, learn the lessons of market history by actually seeing what investors were saying about their sentiment, and then actually see what the prices did going into that extreme in sentiment, and more importantly, coming out of that, right? Is there some predictive value to it? Now, I like to look at the AAII survey in a series of histograms. This is how I have it set up on StockCharts. The green bars, it's a weekly chart, and going back for 5 years, the green bars here give you the bullish reading. So what percent of the respondents were bullish in a given week? The red histogram going below zero tells you the percent that were bearish, right? So again, when the sentiment overall is tilting more bullish, you can see all the bars go higher because there's less bearishness, more bullishness. In a downtrend, you will often get investors becoming more skeptical, and you will get less green, more red, and the entire range shifts down. So just looking at this range and where this histogram evolves is a great visual technique to respect the changes in the sentiment. At the bottom, I'm simply charting the spread, bulls minus bears, and it's a great way to see when bulls far outnumber bears like they did in spring of 2021, when bears vastly outnumber bulls, which is what we're seeing right now. Now, as you can see, I sort of alluded to this. When the market has a good rally, you will often see a spike in bullishness. So late 2017 into the beginning of 2018 is a classic example of that, where the bullishness actually reached an upward extreme, over almost 60% responding bullishness, only about 15% bears, which shows you the spread at an upward extreme. That was pretty much near the end of that 2017 run. It's fizzled out a couple weeks later, and then we had a pretty steep pullback in January into February. Of course, the real correction came later, but that was the extreme and bullish sentiment. When the market really sells off, you can see this in late 2018, you can see this in early 2020, bears far outnumber bulls. So the bullish percentage gets very, very low. The bearish percentage increases. You can see the spread bears far outnumber bulls, and those downward extremes are pretty negative. So you can see when we're at an upper bound or at a lower bound. And again, these are not absolutely bounded. They could technically go to 100% on either side. They've never gotten to that far of an extreme. And usually over 50% one over the other puts you in a very small number of observations. If you look back, in general, it tends to be a lot more mixed. So a couple observations on this before we get to the current reading. First off, you can see that the sentiment was most bullish in March to April of 2021. This is one of the things that caused us to probably be unreasonably negative last year and not as optimistic about the upside for stocks. It took us, kicking and screaming. I feel like we followed the upward trend. Even though price continued to move higher, the sentiment actually peaked out there. So in the summer in particular, the market was going higher, but the sentiment was sloping downwards. You can see the spread, bulls minus bears, was going down. It actually started to turn negative. The first negative reading was in August, and then in September of last year, you finally got some net negative readings, which coincided with this pullback here. Now, one of the comments I've been making to my own subscribers at Market Misbehavior is this shift, how different 2022 is from 2021. And I feel like in November, December really started to get a taste of what 2022 is going to look like, as we had a lot of individual stocks, some of the indexes and breadth and momentum measures all topped out in November, even though the S&P made a higher high going into year end. A lot of things actually topped out in November. So you had that lack of upside confirmation going into a year end. But look at how for much of 2021, it was a net bullish sentiment. Bulls were consistently outnumbering bears until the last couple months of the year. But look at how different 2022 has been. There's been only 1 week, only one so far year to date, where bulls have outnumbered bears. And that was as the S&P was attempting to get back above 4,600 on that week. You finally had bulls outnumbering bears by about 5%. But for the most part, every other week has been dramatically negative. So overall, the conditions have rotated. It's been more negative sentiment, I think, sort of as an exclamation point to the price deterioration we've seen in 2022. That's fine. But what about this extreme comment that I made? So here's the thing. I have these horizontal lines, just a visual guide to show you where we're at relative to where we've been. And I always talk about looking at the final bar, the current price, looking to the left. That's how you focus on key support and resistance levels. This is how you see where we're at relative to where we've been. If you look to the left from the current bullish reading of around 16%, you can see 2 weeks ago, right about at the same level. But if you look to the left, you can see over the last 5 years, we've never been that low. Look at the bearish reading, almost at 60%. We've literally never been this bearish going back for the last 5 years. The spread between the two is right around 43%. That's just the 16 minus 59. You can see going back, we've never been this low. So I've always told people, when you have to bring in way more data to find a historical reference, that tells you we're at a significant point, whether or not it's a significant turning point or whatever, it is a meaningful point to pay attention to. So let's bring in a lot more data. Now we're backing it up to the late 1990s. We're actually looking at 25 years of history here. And you can see we're looking at the same data. So it's a little compressed, but again, we don't really need to see individual observations. What we're doing now is that same exercise, looking at where we're at, looking to the left to see if there are any other times when we've had similar conditions. So 16% bulls, has that happened before? And the answer is not very often. Going back for the last 25 years, I only see one time where we had this few respondents being bullish, and it was in early 2016. This was after about a 6-month cyclical bear market here within the secular bull market phase we've been in, I would argue, since 2013, continuing on through today. So only one other time in the last 25 years that we've had this few respondents saying they were bullish. What about the bearish reading? If you look back, you can see only 2 general periods, actually 3 periods where we've had this much negative sentiment. The first one was here in 2003, and it's notable that it wasn't the 2002 lows over the summer or in October of 2002, which ended up being the ultimate bottom for that phase. It was in March 2003, which is that retest of the lows when the sentiment got so negative, actually undercut the bearish sentiment from the previous bottoms. In 2006, which if you remember was a nice run off to 2003 lows, we had this pullback of about 3 months here, which felt pretty bad at the time. And you can see that the bearish sentiment got to an extreme. Then this whole period, 2008 into the low in 2009, the bearishness was this low, and the lowest reading we've seen, which actually undercut the current reading, over 60% bearish, was at the low in 2009. So you can see that the bearishness only becomes this extreme. The sentiment only becomes this bombed out really at major bottoms is what you'll recognize here. The spread between the two at 43%, has that happened before? Only once in the last 25 years. And again, it's at the 2009 low. So before you take away the obvious conclusion, okay, sentiment is so negative, so this has to be a cyclical bottom before the rotation higher. Not necessarily. And here's my qualification to that. What's the difference? The 2 periods from a sentiment perspective that look so similar, look most similar to what we're seeing now, I would argue would be the 2003 low and the 2009 low in terms of the spread between bulls and bears being so negative, and also the significant amount of bearish sentiment, almost 60% bears. It doesn't happen often, and when it does, it's usually been some of these longer-term pullbacks. In 2009 and in 2003, which you have to remember, that was after a multi-year downtrend. We had been in a cyclical downtrend from 2000 all the way to the beginning of 2003, before the bearishness was this significant. In 2009, we'd been going down for about a year and a half before the bearishness got this severe. So now, after only having gone down a couple months, it's really not enough from a timing perspective to show that we're at a similar point to where we're at here, which tells me that maybe the most similar example is here in 2006, which was a brief pullback, a significant pullback, but a brief one from a timing perspective, not too painful in terms of trend before reversal to the upside. Here's the kicker. What told us that all of that bearish sentiment was over, and I have to point out, in 2008, the reason why when sentiment becomes this negative, we can't just say on its own things are bullish here, because the sentiment is so negative. That first signal we got was in 2008. Compare where we're at right now, this brief pullback of a couple months, to the late 2007 high and early 2008. You can see that the bearish reading finally hit 60% bears, which is right about where we're at right now. After then, we had the whole 2008 to 2009. The next 12 months after that were incredibly painful, and the sentiment remained negative. Compare that to something like 2003 or 2006, where after you had that negative sentiment, the bearish sentiment quickly alleviated. You had a quick recovery, and also the price returned higher. So the price made a new swing high a couple months later and got above the high from the fourth quarter of 2002. In 2006, we made a price recovery and made new highs. So price recovering eliminates and alleviates bearish sentiment better than anything. So at this point, the problem is, are we at a negative extreme in sentiment? Absolutely. Does that tell us 100% sure that the market is bottomed? Absolutely not. And I think while there's a chance we could get a 2006 recovery, there is also a non-zero probability or a significant chance that we could get a brief bounce before the move higher. The reality is, if you look at history, every time we've had the bearish sentiment, we've had at least a brief bounce. The brief bounce in 2003 materialized into a much broader advance. The bounce in 2006 materialized into a broader advance. The bounce in 2008 led to a much more significant decline. But in all of those observations, sentiment this negative means you usually get a bit of a bounce. So I would suggest potentially bouncing off of this 4,100 to 4,200 range could be certainly a possibility that would alleviate or could alleviate the severe bearish sentiment. And then it's all about whether we recover further from there or we undercut the lows. And I would pay attention to that 4,100 to 4,200 range. Continues to be incredibly important here going into May. So there you have it. That is a history lesson of the last 25 years using the AAII survey. Anytime we get to extremes in bullish or bearish sentiment, I find it helpful to look back at where we've been before when those conditions have been similar. The challenge, as you saw from the chart, nothing is 100%. I would love to tell you when this happens, all you need to do is buy, and it's easy, and it's always worked, and it's always going to work. the markets and life in general don't really work like that. But we can learn the lessons of market history, compare right now to 2003, to 2009, and also to 2006 and early 2008. What could we tell from those periods? What told us that the market or indicated the market may have further downside or that we might be in a recovery phase? As always, focusing on the sentiment readings and comparing them to price is what's most important. So again, from a sentiment perspective, extreme sentiment usually means pretty consistently we'll get at the very least a short-term bounce, and then it's up to our analysis of price and breadth and other measures to determine whether that bounce has the ability to materialize into further gains or whether we go on to make new lows. If this sort of thinking about market history, technical analysis, behavioral finance is of interest to you, I hope you'll subscribe to my channel. Also give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Do you feel most likely we undercut the lows from earlier in 2022 and make a new low for the year? Or do we recover from here, make a new swing high above 4,600? Let me know in the comments below and why you feel that is the most likely outcome. For Market Misbehavior, I'm Dave Keller. Take care, be well. Talk to you again soon.